FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Today is 11/26/2020, day after Thanksgiving, and it's the time to start thinking about New Year's resolutions if you haven't been already. And my resolution is always to do better in the market than I did the year before, to make my investments and hopefully to make your investments pay off better than you ever thought possible. And along those lines, we've got with us a special guest. We're going to talk about extreme value investing. And his name is Dan Ferris. Dan, you are editor of Extreme Value, a publication of Stansberry Research. And I'd like to know your opinion out there. Is value investing still relevant? Or have the FANGs taken a bite out of value investing? That's what we'd like to know. Email us, kl@kerrylutz.com. Well, Dan, it's great to have you on the show. So what about value investing? I always think of value investing of like Benjamin Graham, Graham Dodd, securities investing. Even Warren Buffett at one time, he kind of earned his stripes in value investing. But lately, it looks like value and investing seem to be completely divorced from one another.
I would say that they never are. But, it's if you want to characterize value investing as this thing Ben Graham used to do when he used simple metrics like discounts to book value and PE ratios and things like that, if that's your definition of value investing, that's probably not been a great idea a lot of the time for the past 20 years or so. There have been a couple opportunities, but they disappear rather quickly. So if you define value that way, sure, this is a lousy time. The stock market is more expensive at this moment than it's been ever in history, including the .com and 1929 peaks. So you can't do that today, but you can do other things if you define value differently.
All right. So is this a case of value is in the eye of the beholder, or are there objective measures to uncover value? Because then you bump up against the so-called efficient markets theory, which is that the market knows everything and every security is fairly or accurately valued at any given time. But we know that isn't true. So how do you figure out what is I guess we should start with, since the name of the publication is Extreme Value, how do you define value?
The intrinsic value of a business has never changed. It wasn't any different during Ben Graham's time. It's no different in our time. And this goes for any cash flowing investment. The intrinsic value is all the cash flow you'll ever get out of the investment when you own it, discounted back to the present. Period. That's it. That's the intrinsic value. So how you go about analyzing that is a different thing entirely. In extreme value, what we do is we take the normal procedure and we turn it on its head. Instead of estimating all the cash flows and revenues and margins and all those things out into the future and then turning that into an intrinsic value number in the present, we take the present stock price and we plug in whatever numbers in the future we have to equal or really approximate that current stock price. And then we look at what we had to plug in and we say, well, does this represent an optimistic view of the future or a pessimistic view or somewhere in between? And if it's pessimistic, we might have a real good opportunity on our hands. Otherwise, we might avoid it.
Okay, so here's the thing. When you're looking at a security that you believe to be undervalued, but you don't have objective measures, which things like book value, quick ratio, sales to book, sales to asset, all these things, doesn't that kind of like destroy the discipline? Or what kind of discipline do you use to keep your analysis on key and honest?
Well, first of all, the idea that you can reduce the value of a business to something as simple as book value or PE ratio is it doesn't make a lot of sense to me. because what I've learned over the years is that the numbers are a result of something else. All the numbers that you examine, if they're in the financial statements, they're all history, and they were all the result of actions that human beings took based on their corporate culture and their business objectives and hopefully what they do well. And it's not really, it doesn't make a lot of sense to me to try to reduce that to a single metric. That's a common error, I would say, of all novice investors, whether you're a momentum-oriented trend follower or a bottom-up value investor or anything in between. There is no reducing anything to a single metric. That's a fallacy, in my opinion.
All right.
But you're asking, yeah.
So here's a question, though. So maybe you can't use history to judge the future, but you can use history to judge history and see, like Warren Buffett, if you're a lousy manager, he doesn't want you, he's going to fire you. And you can look at history to figure out if the management has run the company well, or maybe they got lucky, they were in the right place at the right time. So you got to use history for something, though, right?
Absolutely. You have to. You have no other choice. And what you do is you look at history, you look at what management did, you look at the results of it, and you ask yourself, can they keep doing this? Or can they maybe even do it better? Is there something they're not doing that they can do? And is there hidden value? Is there some asset that's not being used or realized in some way? So yeah, you have to look at history and you have to know how to use it and understand that, nobody can predict the future, but, when you see a business that has been a really great business for a long time and, nothing's changing very much and it still seems to be a good business right up until the most recent year or quarter or whatever, maybe it's going to keep being a great business for another, 5 or 10 years or something.
All right. Hidden assets. I love hidden assets because it makes me, when I uncover them, feel smarter than everybody else. It's an ego boost. I'll give you an example here, and I'm sure you can give me others. Throughout New York City, Con Edison, that's been one of the premier electrical utilities, but a boring business, 5% growth if you're lucky. Dividends, any company that pays dividends is going to be boring, let's face it. But they owned all of these coal-fired power plants and basically stranded assets throughout the metropolitan area that they couldn't use anymore. And it turned out some of them were extremely valuable, located in Midtown Manhattan. And eventually they just knocked them down and they erected apartment buildings.
Sure.
Finding hidden assets is like one of the coolest things. How do you go about finding them?
FSN Radio. It's all about what's next.
Silver One Resources is an exploration and development company backed by strategic investors Eric Sprott and SSR Mining. At Silver One's Candelaria Mine project in Nevada, there is already a historic resource estimated at 127 million ounces of silver, which Silver One is developing and advancing. The company's Phoenix Silver project, located within the Arizona Silver Belt, is an early-stage exploration project on which native silver vein fragments have been discovered near surface. One grab sample assayed an astounding 14,688 ounces per ton. Yes, that's right, ounces, not grams. Silver One has tremendous exploration potential, is extremely leveraged to the price of silver, and is cashed up and poised to increase shareholder value. Silver One trades in New York under the ticker SLVRF and in Toronto under the ticker SVE. To learn more, go to silverone.com. That's silverone.com.
The Financial Survival Network. It's all about what's next.
They tend to find you, actually. What happens is we don't even necessarily go looking for that type of stuff. In general, we look for what we call optionality. And, a decent example might be we've recommended a company called Altium Minerals that owns royalties on potash mines, among other types of mines. And the potash mines have literally hundreds, and in a couple cases, more than 1,000 years of potash resource in them. And these mines they supply 20% of the world's potash, which is one of the 3 big fertilizers that people use to grow food everywhere in the world. So it's a pretty essential part of the global economy. And the optionality lies in the simple fact that you have this mine, which is normally a wasting asset, but which is the resource is so vast that you can actually grow the production capacity. And a mine that can grow its production capacity over a period of many, many years, decades, or a century even, is really unusual. So there's a source of growth and there's a source of optionality there, and the royalties are on the whole property. That's the way a royalty works. So they don't have to contribute to the capital investment necessary to expand the mine, and yet they still get their proportional slice of the revenue off of every ton of potash sold from the mine. So that's pretty cool.
That is pretty cool. And there's a lot of royalty companies out there now. It became the flavor du jour, especially in the mining industry when capital was very hard to come by. And right. So the royalty streamers popped up, fulfilled the need. Now the need kind of has fallen by the wayside. I've dealt with hedge funds in the past. All they want is a flow of payments that can be discounted to present value, and they're all in. So what other kinds of plays like this do you think we can look to find the optionality you're referring to?
I'm just kind of looking at our list. One source, you may not think of it as directly as optionality, but we've tended over the past 2 years to find companies that are really good at rolling up their industry and growing by acquisition. One of them is the insurance brokers, Brown and Brown. Another one, actually waste management, we recommended that. That was essentially started out as a roll-up of waste management companies. And there are a few others that are more recent recommendations I don't want to mention, but that is a potentially huge source of optionality because you never know when a deal is going to come along that will transform the company. Our most recent recommendation, the company increased its productive asset base by a third within a couple of weeks. Just did a couple deals. It was like under the radar. We're like, wow, when's the stock price going to move on this thing? It's like the world doesn't know what just happened here. And then it did start to move after we recommended it. So that was, one way in which we saw a huge transformation that the world didn't seem to process as quickly as you would have hoped.
So much for efficient markets, right? So
they're not efficient.
Looking ahead, what industries are you focused on now?
We are all cap, all industry. The only things, we see some of the same risks that everybody else does in things like commercial real estate, for example, because there's the work from home movement. A substantial portion of it will remain permanent. And that affects retailers as well. So, there are things we try to avoid risk in situations like that. But really, there's no industry we won't go into if we see a good deal.
Yeah. And that kind of opens things up. Are you U.S., North America centric, or will you go any place in the world?
We are North America centric. I think we recommended companies that are based in Korea, but they're traded in the U.S. And we recommended a company that was only listed in London once. But yeah, North America.
And I think you'll agree, North American markets, particularly American, probably the most rational, probably the most fully valued. From the standpoint that for every company, there's hundreds of analysts chasing it around, crunching numbers, et cetera. Do you see potential outside the U.S. more so? And I'm not talking about China. I'm talking about economies where they actually value integrity in their financial statements, shall we say? Yep.
That's a good way of putting it. As good a way as any. And where they don't steal the intellectual property and all the other problems. So we will look in other places, but I will admit we tend to be a bit shy about it because we live here. We know the U.S. We're not, it's like Warren Buffett used to say, you're not all of a sudden going to start hitting them out of the park when you leave the U.S. But certainly if we find a good opportunity that's outside the U.S., we'll pursue it.
All right. Well, I think you've given us a really good idea. How do you subscribe to Extreme Value?
You can just go to stansberryresearch.com, and right on the home page there, you can look up Extreme Value and you can get to it that way.
All right. And I had Porter Stansberry on the show before, one of the brightest, most astute investors I've ever met. At the time, this is probably 5-6 years ago, we were talking about distressed debt deals. And how debt can be a proxy for equity in certain over-leveraged companies. I know he did well on that, and my hat's off, because all of the publications from Stansberry I've always found to be quite valuable, and I've subscribed personally to a number of them. In any event, we'd like to hear from you what your thoughts are. What's your definition of value? How do you define it? Obviously, it's in the eyes of the beholder, but also there is an objective measure of value out there. Just send us an email, kl@kerrylutz.com. Don't forget, visit our website, financialsurvivalnetwork.com, and sign up for our free newsletter. Dan, it's been a total pleasure having you on. We will definitely talk to you again, and happy hunting.
Thank you. Same to you, Kerry. It's been great to be here.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.